Erik Hirsch, the co-CEO of Hamilton Lane. Erik, it's very good to have you with us. My goodness, so much going on. Where to begin?
And that is the question.
And let's start with that inflation print and what implications that has for the US economy, because this seems to suggest the price pressures go beyond just energy.
They absolutely are. I mean, we're seeing inflation across real goods. You're seeing it across services. And I think so Hirsch is walking into a tough situation. He's going to have a president who loves lower rates and is going to want to be pushing, and sometimes yelling. But yet, when you look at the data, that inflation figure is not backing off, and the consumer is definitely feeling it. The issue in the U.S., though, is you have a massive disconnect across the consumer base. The top end of the consumer is driving the economy single-handedly. They're benefiting from a lot of this. As you just said, record stock prices, real estate prices inflating, commodities inflating, and yet the bottom part of the consumer is really suffering. And so what we see is kind of this K-shape of just total disconnect between the spending levels.
I was watching, when you scroll through socials, you see clips of different people talking.
Careful doing that.
Indeed. You can go down a rabbit hole. But I think it was Warren Buffett, one of the clips that I was watching the other day. He's referencing the fact that at some point we will look back on some of the pricing and the valuations at the moment and think, goodness, those were such silly levels. How come we didn't see a pullback coming?
Well, I think given all that's happening geopolitically, particularly with the Strait remaining closed, the market should be coming down. And yet right now there's kind of a blinder aspect on, and it's saying, damn the torpedoes, full speed ahead. Now, a lot of that is because of AI and this huge wind at the back. And when you look at what's pulling a lot of the economy, yes, we're seeing good stock results from a lot of industrial and manufacturing businesses, but it continues to be the tech sector that is just driving everything forward. And I think there's so much optimism about that. Look at the chip sector, for example, just absolutely on fire, that all of that is sort of ignoring or able to ignore what's happening around the globe right now.
But there's an inherent risk there, isn't there, where
Yes.
the rally is being powered by such a narrow clutch of stocks in one sector.
We are at historical levels for that, truly historical levels. You have to go back into the late 60s, early 70s to see something even comparable. And right now, this is even more concentrated than that. But back in the late 60s, early 70s, and that's a long time ago, those top 10 exposures that were kind of the bulk of the market were completely diversified and non-correlated from each other. You had Exxon and IBM. Well, those weren't in the same sectors, whereas today, not only are they correlated, but as you know and have reported on, there's a whole lot of self-dealing back and forth across these entities, investing in each other. This, I invest in you, you invest in me. And so it's not likely that we're going to see a huge disconnect there.
And, as one of the biggest players in the private credit space, do you still see the hyperscaler opportunity as one that is appealing when you're looking at where to invest?
So for us, that's not been a place where we've been investing a lot of capital. I think you're seeing extreme spending there, and I think this is going to be, some of that will work, some of that won't, but that is not where we're putting our private credit dollars. For us, what we're finding is a much more attractive, very traditional approach. We'd rather be lending to the dental practice roll-up. That is much more back to the basic economy, financing core businesses as they're going about their business. Private credit, in that sense, has really replaced the banks. The dental practice would have normally been banked by a regional bank. And those regional banks today either don't exist at all or aren't really in the business of lending. And so private credit has really stepped into that void. That's at a very different sort of size of business than what you're seeing at sort of the mega end of private credit, which is really banking these mega projects.
And to the point that there's been a lot of reporting about a surge in redemption requests from private credit. Are you seeing any sort of nervousness among your clients?
We certainly see some nervousness among the retail customer, and I think that's been unfortunate in that they are very headline driven right now. So the more this gets discussed in the media, the more we have all these clickbait of there's a cockroach here or a cockroach there. I think that customer, newer to the space, is more reacting to the headline. Because when we look underneath and look at actual performance, default rates are actually declining. So they're sub 2% and dropping. So that's not indicative that we have some big private credit problem. Yes, there have been some headlines, and yes, there's been some cases of fraud. By the way, unfortunately, fraud happens all the time, and that is just a normal course of business. But you're talking about a multi-trillion-dollar asset class. So saying to me, well, there's 5 examples of companies that were fraudulent. Okay, well, that's 5 out of thousands and thousands and thousands and thousands and thousands. That doesn't a big cycle or a bad cycle make.
I just want to get your thoughts on sort of the macro picture and Kevin Warsh now being all but confirmed. Just needs that final flourish of a signature from the president.
Which will happen.
Which will happen. Is he going to be good for the US economy?
I think this is a to be determined. I think he walks in, as I said, to a really pressure-packed environment where the economy and the consumer are struggling. Again, depending on which part of the consumer base we're talking about. And that inflation figure has been incredibly difficult to kind of beat back and knock down. And yet we're going to sort of see pressure from the administration, who is going to focus on wanting lower rates. And I think what we don't know right now is clearly smart, clearly qualified, clearly eyes wide open as to what he's walking into. I think the confirmation hearing dealt with these issues. Now we're just simply waiting to see what will he do. Is he going to stay the course as kind of a normal sort of head of the Fed? Or, as the Democrats are concerned, is he going to be more sort of doing the administration's bidding?
And I was going to pick up on that point because there could be a situation where he has to choose between prioritizing acting in the benefit of Wall Street or Main Street. Because, I mean, look at the US government sold 30-year debt at a 5% yield for the first time since 2007, the FT picking up on that on their website. And so there will be an incentive to try and bring interest rates down to ease the pressure on government borrowing. But at the same time, if inflation isn't going away, that could just fuel further price rises for hard-pressed American consumers.
I think this is one of the core issues that America is facing right now, which is you already have a fairly divided society, both politically and now increasingly economically. And so what benefits one part of society very much harms the other. And that doesn't seem, today, that's very hard to reconcile how you're going to bridge that. Because in many cases, the wealthier are getting wealthier and the poor are getting poorer, and that squeeze and that disconnect is not going away. And so trying to somehow bring that together is a challenge, and it hasn't been resolved, and it's, as you said, it's just getting exacerbated by the economic pressures right now.
Okay, Eric, I mean, we could go on and on and on. There's so much to talk about and such interesting takes and thoughts on it, but we must leave it there. Really appreciate your time. Thank you for joining us here on Europe Early Edition on CNBC. Erik Hirsch there, co-CEO of Hamilton Lane.